Simon Dixon, let's take four of those countries that are in the Eurozone that are surpassing 100% of their GDP. Ireland at 108%, Portugal also at 108%, Italy at 120%, and Greece at 180%. What are these countries going to do to reduce their debt other than austerity? I mean, are there countries in the Eurozone, I'm sure there's some that perhaps are doing okay when it comes to their debt to GDP ratio that maybe you could use as examples for us?
Well, the debt is never going to be paid off. It can't be paid off. And we have to stop pretending that the government actually wants to pay it off as well. Because we have to remember that when you've got a system where all money is essentially debt, which is the system we operate in today, if they ever repay that debt, we end up in a scenario where we don't have enough money for our economy. So the only way that they can actually look at that is actually restructuring exactly the essence of money, and the fact that money is debt is a huge problem. And as Max Keiser touched upon earlier, there's only one result that this can all lead to, and that is that every country loses their sovereignty. Is that there's consolidation of power to an IMF or a European central bank or whatever the next one is, because all of these countries are operating off a system where they won't let the banks go bust. Therefore, the government have to take on the debt. They can't repay that debt, so it gets restructured into a central bank, and that only leads to, you know, an IMF with a special drawing right and all sorts of currencies that we've got coming up. And it's all consolidation of power, and we're just moving in that direction, and that can't be reversed without actually looking at the true nature of our banking system, money creation, and things that no one looks at today. They're not asking the right questions. They're just looking at austerity in order to reduce the government debt, but that's never going to work.
Max Keiser, but in between the lines here, it would be positive to see what actually are on the books of these different banks. Are there hidden costs? Because it seems like, for example, with Bankia, when we hear about the bailout that they needed, do these countries know how much their banks have on paper in terms of assets, in terms of funds, before they can reach out and bail them out? Or are these debts going to all of a sudden surface in the news that they owe this much more? If you can elaborate on that more for us or give us examples.
Well, no, they don't know how much debt these banks have. It's part of what's called the shadow banking system. The shadow banking system in America is estimated to be over $16 trillion. So it's in excess of the entire GDP of the United States. And this is true throughout the world. There's $800 trillion in derivatives that are part of the shadow banking system. The entire globe GDP is, call it $50 trillion. What happens is that when banks want to get more laws passed to deregulate the system, to make it easier for them to continue this Ponzi scheme, they suddenly flash huge debt that they said they just found, they just discovered it. Hank Paulson did this in 2008. Dick Fuld did this at Lehman Brothers. The Troika did this when they were talking about Greece. They have trillions of dollars worth of debt that they can use as a scare tactic to get the citizens and the government to sign off, as was the memo of understanding with Greece, with the Troika. And then when they sign it off, they suddenly say, okay, well, this new lending facility is going to take care of this debt. We're going to lower interest rates again towards 0%. Of course, so the debt service is down to as low as it possibly can be. But I want to follow up on a point of Simon Dixon about the nature of money itself. Most people assume that a bank takes in a deposit and then they loan that deposit out, and this creates liquidity in the system. That's false. In today's banking system, banks first lend money into existence. That's where money comes from. It's loaned into existence as debt. A small fraction of that ends up on another bank's balance sheet that they then call collateral. But it's just debt. There is no hard collateral. That's why at this time around the world, there's a mad scramble to try to reclassify gold as a Tier 1 asset, because that's the only unimpingible collateral that you can have at this point to solve the fact that none of these banks have any collateral that's worth anything in a resale market. They are all technically bankrupt. And this is what they discovered in Iceland, which is why they had to let the three banks, the major banks, collapse. The currency collapsed, the economy collapsed. But now they're growing again because they went through that moment. They realized that they had this huge problem. These banks in Europe have to understand that they must allow the banks to crash and let happen what's going to happen. But until that happens, there's going to be more debt servitude, more problems like we're seeing, more austerity, and more social unrest. There's a real risk now that some of these bankers are going to be rounded up. In the mainstream media in America, Nobel Prize-winning economists and people like Nouriel Roubini are suggesting that bankers should be hung. You know, I said that on this show 3 years ago, and people thought I was being, you know, exaggerating. But now Nouriel Roubini is calling for bankers to be hung. So this is a very interesting sea change.